a market which is broken. We're going to have an avalanche of credit defaults coming up, and the Fed is trying to step in and basically monetize whatever it can. So we have no more yield curve. We have no more credit curve for the time being until defaults are basically allowed to go through. And that means your amount of currency creation in the system is going exponential. And that basically results to a weak dollar. And in return as well, basically, it forces shorts in the market, particularly in the gold and silver space, to cover. That attracts automatically new investors and trend investors and whatever else there's going to be.
What do you see as the ceiling here when it comes to gold prices? You just heard a guest earlier saying 2,000 is within reach. Well, that's obvious given that we're now sitting at about 1950, but 3,000 has been a call that's been out there in the market for some time. Are you that bullish?
I think if you look at the market, the bottom was about 1,050. The old highs were 1920. If you look at the technical picture, you could actually take this gap from the bottom up and going to the top. That gives you about 2,834. And that would be initial target, probably, which we could achieve quite fast. I think my longer-term targets are significantly higher. If you look in the 70s or 80s or 2008, gold price has moved up 7 to 8 times from a bottom structure. So if your bottom structure was 1,050 times 7, that will give you about $8,000.
Juerg, some saying that the deep negativity of US real rates is creating some vulnerability on the price outlook here. What's your take?
Yeah, I mean, I said, basically, we have no more yield curve. The yield curve has been flattened to the extreme. We're moving into negative territories in many countries on real yield return. And that's basically $200 trillion right now of fixed income money, which is looking for a new home. And then you start looking at gold, and you look at the forward curve in gold for 12 months, and it's significantly higher than US Treasury returns. So gold, as a result, starts looking very, very attractive indeed, and that will continue to not just basically attract people who are looking at tail risk hedging, but as well people who are looking at yield creation. And this yield creation on forward rollovers in the futures continues basically to move the market higher and it's forcing shorts to cover.